Hi, Jonathan.
Hey, how's it going?
Good, good. You ready for, I think, chapter 9, right? Chapter 9
Yeah.
on the payroll. We went through, you were not here for the chapter 8 class, but you probably saw the lecture, right?
No, I completely forgot it. No,
Uh-huh.
yeah, I'm gonna watch it today, actually. I'm working on them today.
Okay. Why don't we do this? Why don't we make, I'm going to label this as chapter 9. Let's do chapter 8 and 9 together, okay? I think you're up for that. It
Okay.
won't take us all that much longer. So with that in mind, let me get the PowerPoint for chapter 8. Ah, sugar, sugar, sugar. Come on, modules. Okay. Come on, come on, come on. Okay, there we go. I think I have it now. All right, let's get in here. Okay, Jonathan, we'll take care of both chapters today. 8 is pretty basic, but it gives us a good lead into chapter 9, okay? We have 2 chapters dealing with payroll, chapters 8 and 9. Chapter 8 deals exclusively with doing the accounting for the employee paycheck. In other words, how do we pay the employees? What is the journal entry to record them, their paycheck? What taxes do they pay? What are deductions that come out of their paychecks? So let's go through this. And they start off with talking about different types of payroll record keeping. Um, we'll go past this. This is an important issue right here. I'll talk about it for a minute. The difference between employees and independent contractors. An employee is somebody who works for the company under the direction of the company, is told when to come to work, is told when to leave work, is told what to work on, is given the tools to do the job, and is totally under the management of the company. That is an employee, and as an employee, the company must take payroll taxes out of that employee's paycheck, and the employer must also pay its share of payroll taxes. An independent contractor is somebody who works for the company, but he's doing a job for the company independently. This person is like a plumber who comes in to fix the pipes. It could be somebody coming in to do some auditing or legal work. These people do not receive a paycheck from the company. They get a regular check that they would issue to vendors. Independent contractors are a lot cheaper for employers to handle. Do you remember, Jonathan, last November, there was a big um, initiative on the ballot out here in California about Uber. The argument was, are Uber drivers employees or independent contractors? Do you remember that at all?
Oh, yeah, I remember that big old debate.
Yeah, and Uber and the big Lyft companies put a lot of money into advertising, and they convinced the public that these people were independent contractors. which is ridiculous. These people are told when to drive their shifts. They're told when to pick up the next customer. They're clearly employees, but somehow Uber convinced the state of California that they're independent contractors. So what this means, if you're driving for Uber and you get in an accident, it's your insurance that is the problem. If you're driving for Uber and you get into some kind of dispute with somebody, that is your problem. Somebody throws up in your cab, in your car, that's your problem. So companies can be pretty sneaky about telling the world that someone's an independent contractor rather than an employee because there's less taxes involved. And that's what we're just talking about here. Independent contractors, employees work under the control of the employer. They pay, they're sales clerks, like you're saying here, plant supervisors, accountants, lawyers, maybe, who work for a company. They perform, independent contractors are different. They perform services for a fee and do not work under the control of the company. For example, you hire a public accounting firm to come in. You don't tell them when to show up on your property. You don't tell them how long they have to be on your property. You don't hand them the tools they need to do the job. You don't supervise their every movement. They are independent of the company. They are truly independent contractors. Same thing with construction work. You bring construction people in, the last thing a contractor wants to hear is some nitpicking from the company demanding they do things a certain way. So understand the difference, independent contractors versus employees. The difference boils down to there's no taxes involved with an independent contractor except for a Form 1099 at the end of the year. Government laws and regulations for employees are much more complex. Taxes must be deducted. Payroll records have to be maintained. A lot of reports on independent contractors, like I said, just one form at the end of the year, Form 1099. This here is kind of an important thing, and hopefully a little bit interesting. Employee earnings, 3 steps to determine how much to pay an employee for a pay period. We got to know their total earnings, the amount of deductions, and subtract them to get your net pay, okay? What's the difference between salaries and wages? Typically, salaries are managerial, administrative, normally expressed as biweekly or weekly pays. Wages are people who get paid by the hour, basically. The words are pretty synonymous, though. Remember about the Fair Labor Standards Act, the good old FLSA. It requires overtime for any hour worked over 40 in a week. That is a national law. That is not a state law. It used to be the states had their different rules, but now every employer in the country has to pay time and a half over 40 hours. When compensation is based on time, you got to keep track of it with time cards or something. The hours worked are multiplied by the pay rate. Who knew that, huh? Let's look at a couple things here. Helen Kuzniak worked 54 hours this week. She gets $14 an hour, and she gets paid time and a half for hours in excess of 8 from Monday to Friday, and any hours worked on Saturday are time and a half. But notice she gets double time on Sunday. So here we go. How do we figure out her paycheck? Well, she's going to get 54 hours at straight time to begin with. And then 14 of those hours are going to be a time and a half. So 14 of those hours are going to be paid at $21 an hour. Double time on Sunday, 14 times 2 is 28. You just multiply it out. 40 hours times 14, 10 hours times 21, 4 hours times 28. You follow that, Jonathan? Shouldn't be.
Yeah.
Yeah, that shouldn't be too tough. So now you see how to get the gross earnings for an employee. Now, what do we do when we're talking people who get paid other than hourly? Linda Sweeney has a salary of $2,600 a month plus 1.5 times for hourly rate in hours of 40 per week. So she's paid once a month. but she still gets time and a half if she works more than 40 hours in a week. In order to determine her overhead rate, and any employee like this who gets paid bi-weekly or twice a month or something, you have to break it down to their hourly rate. So she makes $2,600 per month. You multiply that by 12, that is her annual pay. Annual pay. Divide the annual pay by 2,080, and you'll get her hourly rate. 2,080 is 52 weeks times 40 hours. So what they're saying here is divide by 52, then divide by 40. Anyone who's ever done any budgeting at all in the workplace is familiar with 2,080. That's the basis of a 40-hour work week. So we busted her paycheck down to an hourly rate, okay? She gets $14 an hour, and that's the other one. This woman here, we broke her paycheck down to $15 per hour. Compute the overtime rate. It's 22 and a half, 1.5 times. Time and a half, it's called. I'm sure you're familiar with that. Here you go. She worked 50 hours. So simply 40 hours at 15 per hour, $600, 10 hours at time and a half, 22 and a half. Total earnings for that week, $825. Now let's understand what deductions come out of the employee's pocket. What comes out of the employee's pocket are federal and state taxes, plus FICA, Federal Insurance Contribution Act, which consists of Social Security and Medicare. So gross deductions, less deductions, called gross pay, less deductions equals net pay. So let's learn about this a little bit. Federal income tax withholding, required by federal law. It's applied toward the payment of the employee's federal taxes. The amount withheld will be determined by the total earnings, the marital status, the number of withholding allowances claimed, and the length of the pay period. Withholding allowances. When you sign up to begin work with a company, before they let you out in the office or factory or store, you fill out a W-4, a withholding allowance certificate, and you tell them basically, I'm Jonathan and I'm single and I zero children, and they will take out money according to that. You can put almost anything you want on this thing. This is not a hard and fast form. If you are Jonathan and you have no children, but you don't want them to take too much taxes out of your paycheck, you can say, I'm Jonathan claiming 10 exemptions. They'll let you do it. The problem is, though, at the end of the year, you're going to owe the government a big number, and they'll come after you and make you go back to what you should be in terms of withholdings. And there's the withholding form. And this person, it looks like, is claiming four exemptions right there. Total number of allowances, 4. You can have any number you want in there, but I believe if you go over 9, if you go into double figures, the employer must send a copy to the IRS right away. And believe me, they'll check that out. And they'll say, wait a minute. Jonathan makes $1,000 a week and he's taking home $990. What's this guy? Why isn't he paying any taxes? And they would look into that, okay? Wage bracket method, huh? Well, here we're going to have to look at a schedule. Ken Ishtone is married, claims 4. He has gross earnings of $640 for the week. Go to your schedule, find the row for wages of at least, in this case, from 635 to 645. Find the column 4 withholding allowance, and where they cross is the amount to take out. So let's take a look here. He earned $640, I believe, right? $640. So, and he claimed to be married 4. So let's see. Let's see here. Do we have the right schedule? Yeah, married. He earns $640, so he fits right into here. Go over to where it says 4, and $10 is the amount of taxes that will come out of his paycheck. Okay. $10 will come out of his paycheck based on reading that schedule. And I don't think it's too hard to read the schedule. Let's learn about FICA. FICA, Federal Insurance Contributions Act, takes care of two things: Social Security and Medicare. These are mandated taxes. These must come out of your paycheck. They must come out of your paycheck. Social Security is what I'm collecting right now as a retired senior guy. I'm collecting Social Security. You, Jonathan, and the rest of the class, you guys out in the workforce, are having money taken out of your pocket to pay for me, just like future generations will pay for you. Social Security. Also, Medicare. My medical coverage is through FICA. It's Medicare. That's coming out of your pocket as well to pay me now. Future generations will take care of the Jonathans of the world, okay? Look at these, look at the tax rate. You don't have to memorize these, but Social Security is 6.2% on earnings up to 128,400. Medicare is 1.45% on all earnings. Let me go on my liberal political chat here for just a moment about Social Security. 6.2% on a maximum of 128,400. What that means, class, is once you reach salary of 128,400, you no longer pay the 6.2%. This is an example of what's called a regressive tax, in that the more you make, the less you pay. And let me give you an example of that. You earned $100,000 this past year. That's a nice chunk of money, $100,000. So you have to pay $6,200 worth of Social Security tax. But think of the person who earns $1 million. That person only has to pay up until he makes 128,400. So you multiply, let me do it right here, as a matter of fact. If you multiply 128,400 times 6.2, 128,400, I should know this off the top of my head, times 0.062, that's $7,960. The person who made $1 million is paying only 7,960. You divide that over $1 million, that's like 0.0001. So the rich people are paying much less in terms of a percentage, called a regressive tax. Medicare is a flat tax. There's no limit. Everybody, no matter how much money they make, pays 1.545%. You add those two together, it comes to 7.65. And anybody who goes out in the workforce at all, has anything to do with payroll, anything to do with budgeting, scheduling, is going to be familiar with the famous 7.65 deduction. Sarah Cadron had earnings of 2,000. It brings her year-to-date earnings to 127,340. Well, she has not reached 128,400 yet, so her entire paycheck of 2,000 is subject to the 6.2%. Same thing with the Medicare. And of course, there's a lot of voluntary deductions. You know, your company says to you, do you want health insurance through the company? And you probably will say, oh, absolutely. And they'll charge you for that. You might join the credit union. Hopefully there's a 401k plan you can pay into. These are called voluntary deductions. Now, this is pretty simple to understand. Everybody in this class has been in the workforce or is in the workforce now. Computing net pay. Gross pay minus total deductions equals net pay. I bet you're saying to yourselves right now, hey, buddy, I knew that. What I want to bring to your attention, though, is this is the journal entry. The payroll journal entry is just 3 lines. Gross pay. Let's call it what it is accounting-wise. This is salaries and wages expense. Gross pay means a debit to salaries and wages expense. Net pay is a credit to cash. All of your deductions are liabilities that get credited. So your paycheck is your journal entry. Your journal entry is really three things: salaries and wages expense, minus all of the deductions, which are all credited and which are all liabilities, and net pay is cash. Payroll records. I'm not going to go through this in any great detail, Jonathan, and the rest of the class. They're just showing you that you have to keep records for each employee. You got to keep them for the company. You have to have these things kept in very good order. Payroll register. That's the form where each week you list the employee, and then you're going to see their deduction status. They married for. You're going to see their hourly rate. You're going to see the gross pay. You're going to see the net pay, the deductions, the overtime. And this is pretty much it. It's a spreadsheet. Sarah Cadron, she earned $2,000. That did not put her over 128,400. So every bit of this total here is subject to the 6.2%, the 6.2% Social Security tax. All of this is subject to the Medicare tax. The cumulative total. Whoa, look at this. Sarah did go over by 129,400. How about that? And then how much of these taxable earnings are subject to unemployment compensation, Social Security? Look at Sarah Cadron. She's the only one who went over 129. She earned $2,060, bringing her total to 129,400. Well, she only pays the difference between 129,400 and 128,400 because that extra amount, 2,000, is tax-free for Social Security. So you multiply this, you haven't multiply them out yet. These are the amounts of what's taxable for what. This is your total payroll right here. This is how much they've earned through the year to date. This is how much of this total for the period is subject to unemployment, subject to Social Security. And continuing on the next page, subject to Medicare, federal income tax per the table. This person has health insurance, United Way. Subtract them out and you get the total deductions and the net pay. So look at these schedules. They're not too tough. That's what a payroll register is. You're going to have one for each week, and you're also going to have one for each employee. Paying employees, they can be paid by check or direct deposit. We know that. Paycheck earnings statements. Look at the employee earnings record. This is similar. This is just like the payroll register, except it's for one person and one person only. One person and one person only. And this person earned 640 in week 1, week 2, week 3, etc. And we find out that this person is Ken Stone. He lives in St. Louis, Missouri. And here is his activity for the entire year, even showing you the check number they paid him. Okay. So the payroll register gives you week by week listing each employee individually. The employee earnings record gives the employee and that one employee only, his own register. Account for earnings and deductions. Here we go with journal entries, okay? The payroll register is the source for the journal entries. We go back up here, and I'm assuming we're going to use the same numbers we used up here, okay? And we do. Take a look at this. The wages and expense, that's your gross pay. Your deductions, income tax payable, Social Security tax payable, Medicare, etc. Those are all liabilities of the company. It's not the company's money. It's your money. It's the employee's money. But the company has a fiduciary duty to turn that money over to the proper authorities. And your credit to cash is right here. So all of those numbers came directly from the payroll register right here. And here they're showing you the different accounts that we just were introduced to. You have federal income tax payable, Social Security tax payable, Medicare, health insurance, United Way contribution. Could be a lot of voluntaries. Garnishments, what a pain in the neck they are if you know what a garnishment is. It's an employee who's being forced to perhaps to catch up on alimony payments or a debt, and you have to take that money out of the employee's account, regardless of what the employee says. And the accounts involved in payroll accounting, we kind of just went over this a little bit. They talk about different methods: manual, payroll processing center, electronic system. Many companies farm out the payroll function. Doing payroll is not a strategic value added step for a company. It's a requirement. If you run a business, you have to have good payroll records. Many companies farm it out to companies like ADP, Paychecks, and some of the others. You're still responsible for it. You're still responsible for entering the information, and you're responsible for monitoring the registers that everything is okay. Where the payroll companies can save you big money is they'll print the checks for you. They'll publish the payroll registers. But again, this is all based on what you're telling them. So they're just a glorified clerical person doing a lot of grunt work for you. But they do save time and money. You can have electronic payroll systems. We kind of know that. Jonathan, that's chapter 8. Now, that wasn't a buzzsaw, was it?
No, not really. It seemed pretty easy.
Yeah, so let's get into chapter 9, which is a little more demanding. What I'm going to tell you, not anything we can't handle here. Okay, let me pop this up. Okay, hold on, share. Chapter 9, come on. Okay, you see the PowerPoint now for chapter 9, Jonathan?
Yes.
Okay, here we go. Now, what we're going to learn in chapter 9 is how to handle the payroll from the company side, because the company also pays a few payroll taxes. The company also pays a couple of other taxes that the employees don't. And you're going to find that there's a couple that both pay, employee and employer. So let's get familiar with that, get us going here. Describe and calculate employer payroll taxes. In addition to the gross pay, the employer must pay payroll taxes. They pay the following, class. They pay both parts of FICA, which are the pension part, Social Security and Medicare. They also pay FUTA and SUTA, federal unemployment taxes and state unemployment taxes. So let's see if we can get this clear in our head as we go along here. Employees pay federal income taxes. Employer does not pay that. Employees pay FICA, that's the pension, that's the Medicare and Social Security. That number is matched by the company. So that's also a company expense. When they pay your taxes, they're doubling them up when they make the payment to the state or to the feds. FUTA and SUTA are paid only by the employer. So let's understand what taxes are paid by what entity, okay? That's the first thing we need to start understanding to conquer this chapter. And these taxes add substantially to the cost of having employees. Yeah, you don't realize if they're paying you $10 an hour, they're paying an extra 62 cents for Social Security. So look at this now. Both the employer and the employee pay FICA taxes. Each pays the same amount. Social Security equals 6.2% on maximum earnings of 128,400. You're not going to have to memorize the maximum earnings that changes from year to year. It'll be given, whatever they're going to use on tests or in the book, they'll give to you. Medicare, remember, is on all earnings. There's no regression there. Everybody pays the same flat amount. So where are we going to get the number to pay the Social Security? Well, it's going to be the same as the employee. The same as the employee. We're going to go to the payroll register, and we're going to find the Social Security tax number, and we're going to find the Medicare tax number. There it is. So that becomes a company expense on top of the liability that came from taking the money out of the employee's paycheck. So you're going to debit Social Security tax expense. You're going to credit Medicare tax expense. You're probably just going to combine them all into one called payroll tax expense. So let's see what's happening here. Self-employment tax. We're not going to get involved in self-employment tax, except to point out that they have to pay double Social Security if you're self-employed. Self-employed individuals pay both the employer and the employee share of FICA. Let's understand FUTA and SUTA, federal unemployment taxes, levied only on the employer. And the current rate they're using as an example here is 6%. But here's the key point here. It only goes up to earnings of $7,000 for each employee. You have an employee and they earned $7,000 through the first quarter. As soon as they earn $7,000, there is no more taxes to be taken out. So you multiply 7,000 times 0.06, you're going to get $42. That's the maximum for each employee. Employers are allowed to credit up to 5.4 for participation in the state, and the effective rate 0.6 is added to it. FUTA taxes are also calculated in the payroll register. SUTA, same thing. Only the employer pays this. It's levied on employers in most states, and it's used to handle unemployment benefits. Now, these are two taxes, FUTA and SUTA, that are somewhat controllable. If you have a business with very little turnover, you're not sending many people to the unemployment office, you will receive a reduction in the rate, and that can be a significant savings. But if you're a business like, fast food where students come and go, low-wage people come and go, you would have some pretty high unemployment rates, okay? And like it says here, most states have an experience rating system to encourage employers to provide regular employment. Using information, the calculations as follows. The taxable earnings for Social Security was 5,897, and for Medicare it was 6,897. Multiply them out by the appropriate rates, 0.062, 0.0145. Add them together, we get our famous 7.65. FUTA is 0.006, not 0.06, 0.006. So this is money that is only taken out of, that is only going to be paid by the employer up until $7,000 per employee. FUTA and SUTA, employer only. FUTA and SUTA, employer only pays it. Right here, here's state unemployment. 360 times 0.04, there we go. You add these four numbers up, the 365.61, the 100.01, 216, 1944. That total represents your debit to payroll tax expense. That would be your debit to payroll tax expense. Account for employer payroll tax expenses. Well, they're making this look a lot more complicated than it really is. Basically, what they're saying is go to your payroll register and get the information. figure out the Social Security, the Medicare, the FUTA, and the SUTA. We know how to do that. The Social Security the Social Security salaries come right from the payroll register, as do the Medicare salaries. And the same thing is true of FUTA and SUTA. You just multiply them by the appropriate rates and add them up, and that is your payroll tax expense. So let's see what we have here. Payroll tax expense, $487.22. And that looks like it's these numbers here, 365.61, 100.01. Take a look at it. There's your journal entry. Keep in mind, this has nothing at all to do with the employees. Has nothing to do with the employees. This is the portion paid and borne by the company. So you debit payroll tax expense, you credit Social Security taxes payable, Medicare, FUTA, and SUTA. And at the end of the month, the company is responsible for making all of these payments to the appropriate agencies, okay? And they're just introducing you to a few more here, FUTA and SUTA, federal unemployment taxes, state unemployment taxes, and there's payroll tax expense. The tricky thing to keep separate is what is an expense that the employee is stuck with and what is just the company's portion of it. And they're showing you some of the accounts you're going to use, FUTA payable. We know this already. We're going to debit payroll tax expense. We're going to credit Social Security. We're going to credit Medicare. We're going to credit FUTA and SUTA payable. This kind of makes me chuckle here. The total cost of an employee. You have an employee who makes $26,000 a year, right? Well, the employer has to pay 6.2% of that $2,600 as payroll expense. So they come up with 1612. They have to pay 1.45, and they have to pay 5.4% on the first 7,000. They have to pay 0.006 of the first 7,000. So what they're saying is you take the gross pay. The gross pay is the same thing as salaries and wages expense. So you have salaries and wages expense plus the employer taxes, means that this person is actually costing the company $28,409 a year. And I've had this thrown in my face on an occasion or two when I was much younger. You go into the boss once a year and you want to get a raise. I go in there and say, "Oh, boss, thank you for the comments that I did a good job. I'm making 26,000 now. I'd like to make 29." And the boss will say, "Hey, you're already making 28,400, buddy. I can't go up any higher than that." And he would throw this in your face. You have to learn to negotiate past it. Describe employer reporting and payment responsibilities. Okay. This is not going to take too long. The employer is going to use the payroll register to get all of this information, okay? So you have to send out at the end of the year W-2s to everybody. You know what the W-2 is, I bet. You're sitting home in January and all of a sudden the mail comes and you say, "I made $4,000 on my part-time job and they took $380 out of my paycheck. Hey, I'm going to get that refund." That's the W-2. The W-3 is just the total. And employers must verify eligibility with the Form I-9 that you are indeed eligible for working in the United States. Federal income taxes. 3 important aspects of employer reporting and payroll responsibility. Determining when the payments are due. Everybody uses electronics now to make their payments. And the 941. And I'm not going to get too excited about this, but what they're saying is the size of the payroll might indicate when things get paid. If you have a small payroll, just $2,500 a quarter, maybe a one-man business, you pay with the 941 at the end of the month. But if it's up to 50,000, you better make the payment in 15 days. If it's more than that, you got to make your deposits every Wednesday or Friday. If it's 100,000 more, you better put the money in the next day. So the higher the payroll, the quicker the payment is due. Look back period. I'm not going to go over the look back period. Making federal tax deposits is, well, again, you're getting it all from the payroll register. And here is what we do when we make the payment. You remember earlier, we debited payroll tax expenses and we credited federal income tax, we credited Social Security, we credited Medicare. This is the employer side right now. And we make a payment of cash, $6,325 to the United States Treasury. And we do the same thing with the FUTA and the SUTA. The Form 941, if you go back any ways at all in accounting years back, these forms had to be prepared every quarter, the quarterly 941. And what it does, it just reconciles what you took out of employees' pockets plus what the company should have paid on top of that. And then you match it up to the deposits you sent into the government. And they better be pretty much the same number or there's going to be a problem, okay? I think they allow you leeway of $1 or so. But that's the 941. Again, if you want to learn about payroll, take Professor Pamela Fack's payroll class and you will become experts in all of this information. FUTA, remember, we had was it $500 in FUTA, $508, FUTA payable. We debit that now because we're making the payment. We do the same thing with the SUTA. Form 940, that's just a glorified 941. It is, let me say it this way. The 940 is actually for the Medicare. You'll see it right here. I'm babbling a little bit. The 940 is the form for the unemployment taxes. You put that together here. Again, you don't really need to worry about this, okay? Just know what the 941 is. The 941 is the mechanism for reconciling the taxes paid to the federal government. The 940 is just for the FUTA only. FUTA, we're not going to look at the forms. And we had SUTA. Remember SUTA? We debit SUTA payable because now we're going to pay that $3,240 and we're going to credit cash. And they're showing you a W-2 here. I bet you all recognize that, a W-2. The company is Wesley Incorporated. The employee's name is Ken M. Eistone. Well, he had a salary of $32,665, and that salary was fully taxable for Social Security. It was fully taxable for Medicare. They're showing you how much came out for federal income tax, Social Security, and Medicare. If I'm looking at this right, this guy earned almost $33,000, and he only paid $530 in federal income tax. He's going to get a nice letter from the IRS shortly. And then the W-3, this is just the cover page for all the W-2s. It's the same form, just has all the totals. The I-9, I don't think we need to worry about I-9. Let's finish up describing an account for workers' compensation insurance, okay? Workers' comp, you've heard that before, workers' compensation insurance. Companies must carry a policy in case someone gets injured on the job. It's required in most states. The employer pays the entire cost. Employer pays the entire cost. And it depends on the number of employees, the riskiness of the job, and the company's accident history. For example, a commercial fisherman has much more dangerous work to perform than does somebody in an office. So the rate would be very high for a commercial fisherman. Employer usually pays premiums at the beginning of the year based on an estimate. That's exactly what you do. At the beginning of the year, you're looking at your budget for the next year for payroll. You take that number and multiply it by the workers' compensation rate you've been assigned, and you make the payment at the beginning of the year, adjusting at year end, okay? Workers' comp is very controllable by the employer. If the worker is in an environment where they're safety conscious, they don't leave oil spills lying around unattended, things in the aisles, you can really minimize your accidents, and in so doing, you will lower your rates over time. So let's take a look at this. Lockwood Company says our payroll for the year is going to be 210,000, and the workers' compensation insurance rate is 0.002. $210,000 times 0.002 is 420. You debit workers' compensation insurance expense, and you credit cash for 420. It's as easy as that. Then, at the end of the year, you see how close you came to your estimate. Well, he estimated 210. What did he estimate? Yeah, I'm sorry, estimated 420, and it actually came out to be 440. So that's an additional expense you have to bear, $20. If it went the other way, you'd have income of $20. You'd be getting a refund. And that's what you're showing you here, going the other way. And Jonathan, believe it or not, that covers all of chapters 8 and 9. What do you have to say about that?
Oh, wow. That's not, I mean, it seems kind of tough, at least chapter 9, but I mean, I think I just need to get down into the books and actually do it. And, it looks doable,
Yeah,
overall,
it's certainly
I
doable.
should say.
Yeah, just try to understand the journal entries and understand what is paid by the employee and what is paid by the employer. Yeah, did you know the employer matched Social Security expenses? You
I
probably,
didn't know that.
yeah, you probably most of the class doesn't know that. But that's interesting to know. So whatever comes out of your pocket for Social Security, both sides of it, the company has to pay as well. To them, it's an expense. Your monies to them are a liability. The only expense is the wages expense itself, okay? Got any questions, Jonathan? We'll set the run here. Are you okay?
Yeah, I'm good. Just wanted to say thank you for doing 2 chapters in one day. That you didn't need to do that, but you did that, and I appreciate it.
I'm glad
So
I'm glad to have you
just
here. It's
gotta
always
say thanks.
good to have one person to be my audience, So all right, Jonathan, I'm gonna end the meeting now, okay? We'll see you later, man.
All righty, have a great day.
Hey, bye-bye.